just allowing a few more people to come in. Some latecomers joining the call now, so we'll start this in just a minute or so. Thank you for joining us for this first one. We do plan to make this a regular thing around all the Fed meetings, not just for this one. So thank you for joining us, and please do join up the future ones as well. If everybody likes it enough, we may even extend it to the ECB and Bank of England meetings, but subject to constraints on the people's time involved. But if you like it, please do give us the feedback afterwards. If you don't like it, give us the feedback as well. We can try and make it better next time. Given that part of the idea was this to make this short and snappy, given we've got a number of people on the line now, we will get going. We will follow it up with a blog post in the next 24 hours as well. So anybody who joins late will be able to pick up some of the details from that there. So good morning to those of you joining us from the US, and good afternoon to those of us joining from the UK. I'm Nigel Owen, Head of Corporate Origination at Treasury Spring, and I'm joined today by our US CEO and Global Head of Capital Markets, Henry Adams. Good morning, Henry. Are you well?
Yeah, good afternoon, Nigel. Doing very well. Pleased to say it's a lovely sunny Manhattan morning out here, and looking forward to getting into some of the bones of what's been happening in the last 24 hours.
Great. Well, welcome everybody to this inaugural Follow the Fed briefing, where we do intend to take just 15 minutes of your time to dissect yesterday's Fed decision, the dot plot and Jay Powell's comments, and translate them specifically for Treasury professionals like yourselves. I'll be giving you my views for more than 2 decades in the debt capital markets, while Henry will be doing the same from a similar length career in the rates market. So without further ado, let's get into what you've come to hear. You all know by now, I'm sure, the Fed cut rates by 25 basis points in a perhaps surprisingly united vote, which we'll address shortly. But this is the first cut we've seen since December last year. So Henry, what's changed since the end of July to prompt a cut this time around, in your opinion?
Yeah, absolutely. Thank you, Nigel. So certainly from what we've observed on the desk here, there's a few factors really worth mentioning to help set the scene here. So let's start with some of the positives. And there's certainly the good news, a bunch of those. So look, firstly, trade policy uncertainty is really returning to more normal levels. And coupled with that, of course, economic policy on a more micro level, but really to help us understand what's going on, get a finger on the pulse of the economy here. A couple of points additionally worth mentioning. So restaurant bookings in the US, air travel demand, both remain robust. Why do I mention this? Well, historically, these are actually really some of the first items households rein back on when starting to feel the pinch. Retail sales also looking positive, climbed an additional 0.7% for the month of August, this defying expectations of many an economist, certainly from what I've seen and read. People are still spending, this despite certain goods being more expensive following the rebalancing of terms of trade via tariff, of course. Whilst Fed data shows wage growth has cooled, still remains above inflation, thus folks are seeing their income rise in real terms. Generally speaking. But look, just yesterday as well, we saw the Bank of America once again increase the minimum wage now to $25 an hour. Other positives, commercial bank loan growth is increasing, meaning more credit being put into the system. So financial institutions remain comfortable continuing to extend credit into the real economy as it stands now. This is also helpfully corroborated by bankruptcy filings, which are remaining stable. But look, on the flip side, every tale, of course, 2 sides. So despite retail sales growing, there's been a modest slowdown in consumer spending growth, particularly in those sectors most affected by those changes in terms of trade and tariffs. So look, is this an opportunity for domestic firms? Perhaps. Although time to market, of course, dependent on the complexity of the underlying goods, the reliance on materials and other inputs to manufacture said goods, and of course, where they've come from and at what rate they will be taxed. The labour market also been cooling. We've seen the headlines and really the big argument for this cut, I'd say. So look, the most recent data on applications for US employment benefits jumped to the highest level in almost 4 years. What could this imply? Well, unfortunately, more people are getting fired. The US economy added just 22,000 jobs for the month of August. This, according to the Bureau of Labor Statistics. And look, there are currently 7.4 million folks unemployed in this great country, with just 7.2 million jobs available. The last time we witnessed a shortfall, scroll back to 2021. Manufacturing also remaining muted. This in part off the back of lagging capital spend. Unfortunately, uncertainty also not our friend here. But of course, look, the reason for just 25 basis points and also for some hawkish views here, which we'll get to. The elephant in the room is, of course, inflation. With a target rate of 2% and the most recent print for August being 2.9% on an annualized basis, price increases remain well above what is deemed price stability, a bit of a conundrum.
So, Henry, you're saying you feel the FOMC is currently more focused on the labour market than inflation. Given we had the latest inflation figures out very recently, is that a dangerous strategy in your view?
It's just an incredibly difficult spot for the Fed to be in, frankly. What you wouldn't want to see is continued cooling of the labor market without support. Interest rates are a blunt instrument, but do the job. But that genie of inflation, were that to once again get out of the bottle, and we have to then see increases in interest rates, that is going to be, yeah, a real problem because, of course, increasing the cost of money does cool. And when you've got other factors that are pointing to a cooling economy, stagflation becomes a potential outcome.
Sure. And we had a cut with the PCE price index still forecast to be 3% by the end of the year. What risk does that portray for the markets and for the treasurers that we've got on the line today?
Yeah, look, that is a good question. And I think it's one of those ones that's really going to require more data for us to get a full understanding. There's still a degree of volatility coming through, particularly given that, look, not all tariff negotiations are complete, including from some of the larger trading partners, or effectively countries that goods are being imported from. So yeah, time will certainly tell. Um, but yeah, I would say 3%, given we're at 2.9% now. I do think that that is at risk, and at risk of effectively coming in higher than that 3% level, perhaps a little optimistic. Hopefully correct, ideally lower.
Okay, well, looking forwards there, we also had an updated dot plot from this meeting, and I can show our clients on the line there this chart that we have created, which allows you to see the comparison between the dot plot that we had in June and that we had in September. It's somewhat changed shape since we saw it after June's meeting. What are your main takeaways from those changes in shape?
Yeah, sure. Look, I mean, there is a change. It's not drastic. I guess as we know, 11 of the 12 voting members did vote for that 25 bip cut. Just one pushing for 50 basis points. There had been speculation in the media that there might be more dissent. Looking at the dot plot, looks like we're okay here. In isolation, a united committee. Trump advisor Mirren, the dissenter, and that's probably not much of a surprise to the market, let's face it. An otherwise united Fed was well taken, judging by the lack of volatility post-announcement, and this really coming from that dot plot. So looking forward, a little lower, but otherwise, yeah, tracking where we saw from the last dot plot.
And how have you seen markets adjust their expectations of where rates will be by the end of the year and beyond from where they were when you looked at it yesterday and earlier this week?
Yeah, sure. I mean, that is really the question, isn't it? What impact has this had, and how should we be thinking about that? Well, look, pretty much unchanged. Good news, as we know, uncertainty, volatility, not our friend, particularly those folks sitting in Treasury that need to be now, of course, as well, thinking about forecasting. So, look, from publicly available data, this derived from futures pricing, indicating very little change. For market pricing, it's indicating we're still on for two consecutive cuts, 25 basis points in both October and December, which would see us at a range of 3.5 to 3.75%. This does feel accommodative to me, particularly given we are still coping with higher than desired inflation.
And there's been a lot of focus on the steepening of the curve in recent months, with the long bond breaching 5% on a couple of occasions in recent months. How has this meeting affected the longer end of the curve from the limited trading you've seen this morning? And should our friends in Treasury on the line be worried about that at all?
Yeah, very good question. Look, as always, important to look at one's maturity profile and the context of current and expected market conditions, not just outright government bond pricing. So look, the cost over and above the risk-free rate remains near the tights, frankly. Looking back over the last couple of decades, good news is market looks open. But as our in-house credit expert, I think that our audience would love to actually hear from you on this one, Nigel.
Yeah, sure. I mean, I think the positive for treasurers who are looking to enter into the bond markets is that we have been at or close to long-term tights in spreads for some time now, and we've seen strong demand. Order books have been very strongly oversubscribed. The increased yields in benchmarks mean that spreads can remain tight, but investors can still get good nominal returns, which I think is why that demand will remain deep into the year. If you believe the stock market will keep going higher, which it does, you believe in the outlook for the US economy. So hence you trust the ability of corporate America to repay its debt. So tight spreads worry you less while you're picking up material nominal yields. We might see a little less liquidity in the short end as money from bond funds prefers the yield in longer dates. But that does assume we don't have any further geopolitical or tariff-like shocks, something that is bold to ignore in current times, I think we'll all agree. But despite the cut, the benchmark rate remains higher in the US than Europe and the UK for now. So investors will continue to demand US paper. While borrowers may want to borrow at the lower nominal yields in euros or sterling, where the market's starting to price in the bottom of the cutting cycle, well, it feels like we've got plenty more wood to chop in the US yet. And Henry, just related to that, we've seen the dollar weaken since the last Fed meeting. How have you seen it react in the last 12, 14 hours or so? And where do you see that going from here?
Yeah, no, look, good point. Look, the reaction is the market has been buying dollars. And whilst early signs include risk assets pointing to the music not stopping for now, naturally, when thinking of a strong dollar, the important thing also to consider here is where those largest trading partners lie, and then to what degree inflation might be imported and then impact on interest rates. I do see reasons to be optimistic. Continued strength does help disguise some of those tariffs as well, whilst increasing income, of course, for the US Treasury. But of course, look, inflation, were it not to be tamed and growth along with jobs continuing to slow, I would be concerned both for dollar strength and that risk of stagflation.
Okay, and one thing Jerome Powell's never veered from is his insistence that decisions will be made based on data. But even he admitted last night that there are now two-sided risks to the equation that the Fed's having to consider. There's plenty of data to come out between now and October's meeting, but is there anything other than the obvious in inflation, whether it's CPI or PCE, and the obvious labour market measures of wage inflation, payrolls, numbers, unemployment, that you'd recommend that folks on the line pay close attention to before then?
Yeah, I think, look, some of those early indicators discussed at the very beginning. So, how do you get a pulse? Where's the canary in the coal mine? Looking at things like extension of credit from banks, bankruptcies, and to what degree that might be changing and the velocity of that change, as well as some of the more minutiae in the data, such as, you know, some of those discretionary spends that consumers make.
Okay, and as we're getting close to the 15 minutes that I promised people we'd only take up, I'm going to ask you to play Fancy Fed now. So look forward to the next meeting and give me how you'd vote, why you're going to vote that way, and if you think that differs from what will actually happen.
Yeah, sure. So I'll do it in reverse. Actually, I think we will see the 25 cut. The market doesn't like being disappointed. We're aiming for a soft landing. Um, I'd be looking at continued spending patterns effectively, but given where inflation is, I'd be more inclined to hold and spare that ammunition for a day where the clouds are starting to form a little more firmly.
Okay, and so that I'm not accused of not putting my own mouth where the money is, I'm voting for no change next month as well. I do just think the risk of inflation outweighs a labour market that's still doing okay. But I think we'll be in the minority as the majority go 25 basis points again. You will, of course, be able to hold us to account on those predictions next month if the powers that be allow us back, which is a hint to say, please give us good feedback if you want to see us again. You can catch up with Henry's thoughts in the interim by using the QR code that will come on at the end of this call to sign up to our What the FTF newsletter. And I publish a brief data commentary every week on my LinkedIn page under the banner of 5 to follow. So thank you to you all for joining us today. I hope you found it useful. Have a great rest of your day. And Henry, thank you very much for your insights.
Thanks all and have a wonderful day. All the best.
Thank you.